For everybody, that's all you beautiful people out there. I can't see you, but you can see us. I am, I'm streaming from the house today. And so we have Jake, our own Jake, not Jake from State Farm, but Jake from Raymond James. Our Jake is, he's a cooler version, okay? We got the James Bond, British Jake. And then we have my good buddy over there, Damian Eckstein. We both share the same barber. And Damian, I see you got in this week as well.
Yes.
Yeah. So we're going to give it a couple more minutes. Well, actually, we're going to give it about one more minute, and then we're going to get started with some really good content. Most of you, if not all of you, know Damian quite well. For the last decade, he has been very gracious host. He's opened up the American Funds, one of the regional offices here. In the past, we've had some of our client learning events there, and he's also hosted a couple luncheons for us. And most of you have heard him last year, at least a couple times, as one of the keynote speaker at our Zoom meetings last year, keeping you guys abreast of what was going on during a very difficult time for all of us. So we are very grateful to have this strategic partner with American Funds. They are, I will say, our #1 mutual fund family, and they make us look good. And so we've been using them for over a decade now, and so we're very pleased with what they bring to the table. At this time, I think it's time for us to go ahead and kick it off, and I'm going to lob it over to Jake and let him go from here, and then he will pass the baton over to Damian. Okay, Jake, take it from here.
Sounds good. Thanks a lot, Rod, and I appreciate the James Bond shout. I've been getting Jimmy Fallon more than James Bond lately, so I'll take that any day of the week. So first off, thank you all very much for joining on this Friday afternoon. Damian and I were just talking, we're going to start getting traveling again soon. So I live in San Diego. I look forward to meeting, some of you, if not all of you, in person at some point in the next year or so. But certainly do appreciate you joining this webinar today. As Rod mentioned, I am a Raymond James employee. I started off at the headquarters in St. Petersburg, and about a year ago, I moved to the West Coast, and I travel for the department now. I'm not going to run through my position and what I do for the firm, because I've explained that on previous webinars, but really just think of me as an extension of Rod's and Adam's team. I'm really there to help support them. Obviously, the headquarters, Raymond James, is based in St. Petersburg, Florida, so I'm their local West Coast consultant, and I'm here to help them in any way I can. So I think before we turn it over to Damian here, I think hopefully, we can make this as interactive as possible. If you look on the bottom of your screen, you will see a Q&A box. If you click on that, you can submit as many questions as you like. As soon as they come through, Rod and I will see them pop up and we'll address them. So please, I encourage you to ask as many questions as you like. And with that, Damian, really do appreciate you joining today. Thank you very much for your time. Damian's going to run through the American Fund models, kind of give an update on the positioning with American Funds, and then sort of the second part of his presentation is going to be more positioned towards current market conditions and how they feel. So with that said, Damian, thank you for your time, and I'll pass it over to you, sir.
Wonderful. Jake, thank you for that. Rod, as always, appreciate the opportunity to visit with you and your investors. And I'll say we've done a lot of these over the years. I don't mind being at home and staring at the computer screen, but I look forward to the day that we do this with handshakes and hugs again in person, like we did in the past. So, for those of you on the phone or on the other side of the computer screen, we appreciate the continued support of the American Funds. I mean, we have one sole mission as an organization. It's to create better outcomes for investors. That's all we do. We don't own a bank. We don't, we are an investment firm. And the way we succeed is helping folks like you succeed in getting to the outcomes you want. And I think I'm going to go back to outcomes later as I talk about these models, but we're all successful if the goal and objective you set is hit. And I know that's what Jake looks for. I certainly know that's what Rod strives for. And we've been blessed to work with him for a long while. And I could speak specifically to the 10 years that Rod and I have worked together, and it's been a fun partnership. So thank you for your time. I thought what I'd do is like 3 or 4 things. And I'm going to try and accomplish it pretty quickly. If there are questions, feel free to put them in that Q&A box. And I know either Jake or Rod will pop in and ask them of me. And my wife would be the first to tell you, I will just go if you don't ask me to stop. So if there's something that you want to know, if there's something you didn't understand that I said, please stop me. But here's what I would like to accomplish in the next 20 minutes or so. I want to talk a little bit about our models. And to do that, I'm going to talk about a first and foremost, a team of proven portfolio managers. Secondarily, I'm going to talk about the way we think about portfolio construction. How we're building these models to help you hit that objective or goal. The third thing I'm going to do is show you the models real briefly and some of the underlying holdings, which is probably less interesting. I'll do that one real quick, and then I'm going to pivot into, and it's shocking to say, our mid-year outlook. 23 days into the second half of 2021, and I'm just so glad it's not 2020 any longer. It felt like the year that would never end. Sometimes I'm starting to feel that way about 2021 as I've spent way too much time at home, but certainly the world seems to be normalizing a bit, especially from where we were about a year ago. So Rod, does that sound like a good agenda?
Sounds perfect.
Perfect. I have the ability here to share my screen, and this isn't of utmost important, but I think sometimes seeing the picture of the individuals. We started doing portfolio construction in multi-asset. So multi-asset just means you're doing stocks, bonds, so owning companies, owning their debt, other investments. With the onset of American Mutual Fund, and it's easy for me to remember when American Mutual started because it was 1975, which is about 46 years ago. And I know that because I too started in 1975, which used to people go, oh my God, you're so young. And now I realized, oh no, I'm no longer so young anymore. But for 46 years, we've been in this, as an organization, have done multi-asset portfolio construction. But in 2012, we formalized that a bit more and started running some models. On the back of some changes with retirements and target date funds, and we put together, and I think it's important to start with this. We put together a group of investors. We call it our Capital Group Portfolio Solutions Committee, which you see right here in the middle of the page. And they're managers in underlying investments at American Funds. So we didn't go out like other firms and hire strategists that had never, quote unquote, touched the money and asked them to create portfolio construction. What we did is we took some of our best and brightest portfolio managers and had them join a committee that created all of our portfolio construction. And I'll talk about how we think about portfolio construction in a moment. But, in an attempt to help investors hit objectives, not with singular mutual funds, but a combination of funds built to hit, various objectives. What you'll notice about each and every one of these individuals, and I always joke with some of them because I look at them and I go, man, those pictures look a lot younger than they do in real life. The average experience is near 30 years. And in total, this group is responsible for monitoring about $100 billion of multi-fund solutions. So it's not an insignificant group. And if you see here, the years each, so our most seasoned is Alan Barrow here at 35 years, runs the gamut, but an average of 29 years. And what you'll see underneath them is their area of discipline. So Alan Barrow is a manager and principal investment officer of Washington Mutual, with many of you might know. He's got 35 years of investment industry experience. His focus is equities or stocks. Michelle Black, 26 years. She's multi-asset, so she works both stocks and bonds and other asset classes. Same with Samir. Wesley Foa, multi-asset with a tilt towards fixed income. John Queen is fixed income only. So we get a group of our best and brightest, put them together, and task them with the following. How do we help you as investors get to where you need to be? And it's going to be different. And this is the reality. Rod knows each of you individually. He knows what your goals are, what the objective of the money is. Some of you might have a pension that you'll never spend all of it, and this money is aspirational to maybe go on some great trips and leave something to the kids. There might be others that are more like my parents, and they want to spend every penny before they go. Like my dad says, his greatest hope is that he spends his last penny as he takes his last breath, and there's nothing left for my brother and I to waste. So everyone's going to have a different goal, a different objective. Some might want to think about college cost planning for their kids or grandkids. Some might think about retirement. Some might be saving for a second home, a first home, a third car. And we tried to build portfolios using this group based on that thought process. Because, and this is normally when I'd ask a question, but since I can't actually get an answer, I'm going to ask the question, I'm going to answer it. How many objectives are there truly from an asset management perspective? And the answer from our view is three base objectives. Objective one, grow the money. Okay, that seems pretty easy. You give me X, I want it to be X plus in some date in the future. The second objective potentially is income. I have a lump sum of money. I've now retired and I just want to draw income off of it in perpetuity. And the final is conservation of capital. And that's, I jokingly say you've got so much money or a pot of money that you don't want to lose. And you care less about an income source. You care less about it growing. You care most about it not going down in value. So those are the three base objectives. And then we build all of our portfolios trying to put some of those together, right? And ultimately, that's our goal from an organization perspective. And in some cases, you as an investor might have two buckets of money in your head. There's bucket one that you want to buy a new home in 2 years. You don't need it to grow. You just want to make sure it's there when you're ready 2 years from now. And the goal of that money might be conservation of capital or preservation. And then you might have a secondary bucket that you're not going to touch for 30 years. It's retirement. And the base goal or base objective of that money is pure growth. So we've put portfolios together where you could use two of them, and we'll talk about the portfolios in a moment. Together, you could use three of them together, but they're all based on the objectives and the reality that sometimes an investor might have a dual objective. So we've built some of the portfolios around an idea of growth and income. So I want the money to grow, but I also need income as I go. So that's the way we think about portfolio construction. And it doesn't always mean putting the best funds together. And the reason I say this is if you put a portfolio together today, January, I wish it was January, July 23rd of 2021, in the midst of a pretty good market move, and you said, I want the best fund in every category. Well, the best equity funds and the best stock funds and the best bond funds might be more similar today than they are different, right? Because in a good market, the best bond fund might be one that's taking more risk, as would be the case with a good equity fund if you just simply looked at the numbers. And that works really well until something like last February and March occurs, right? You get a downturn, and if all of your guns are faced this way, but the market turns this way, and you don't have anything playing defense, it can get difficult. So our goal as an investment shop and a portfolio construction firm or group is to make sure we put pieces together that serve the right purpose. So when we buy stocks today, we might say, okay, these stocks in this particular portfolio are being purchased because we think we're going to take advantage of some upside. But to make sure that you're comfortable as an investor and that Rod's comfortable with the portfolio for you as an investor, we might own bonds for a very different reason. Those bonds might be held in the portfolio, in a particular portfolio, as the defensive or insurance policy of the overall portfolio. So we think about things that way. And then in terms of the availability, so Raymond James has a risk scoring tool, and you'll see here, and I'll highlight them. The risk scores correspond with 5 different asset allocation or strategic allocation models: conservative, balanced, balanced with growth, and growth. Again, around those objectives. And then if you look at the 5 available, starting most conservative, which is all the way on the left of your screen, you've got the American Funds Conservative Income Model Portfolio. And the goal of that is more conservation. It's a higher allocation to fixed income relative to the far right, the American Funds Growth Model Portfolio, which is essentially all equities. And Rod, I think I saw some hands raised, so yeah, I don't know if I want to pause real quick here.
We have a very dear client, Dorothy Ingraham, raised her hand. Okay, so let's address Dorothy's question.
I don't see a question that's come through.
Okay.
Dorothy, if you hover over your main screen, you should see a few options, and one of them should be something with a Q&A box. So if you click on that and submit the question, okay, that should come through.
And it's same for Rando Cox as well.
Perfect. I saw the hands raised. I didn't know if, but I can't on my screen see the question. So, okay. But just should I take a pause here and let the question come in, Rod? You want me to keep rolling?
Let's do this. Let's hold the questions till the end.
Okay. So, you know, from our perspective, and I could go back to the screen and share, but essentially what Raymond James has done in conjunction with American Funds is we've got these 5 models that meet various risk parameters and allow Rod to feel comfortable with the outcome of the more conservative portfolio, the conservative income model portfolio that we run, will fit somebody with a risk score that's lower than obviously somebody that has a more growth portfolio intact. Now, we as an investment firm continually monitor these portfolios, and there's really 2 main ways you'll hear about portfolio construction. One is more strategic, and as the name suggested, I said it earlier, Raymond James strategic asset allocation models. The other is tactical. I've always viewed tactical as sort of this all-knowing hand coming down and saying, I'm going to make a big change. We're going to get out of the US. We're going to buy all international and make these big swings in the portfolio. We've been around 90 years as an organization. And in 90 years, you learn a lot of stuff. And some of it's good stuff and some of it's bad stuff. But what we know about ourselves as an investment organization is that in 90 years, if you looked at all of the excess return we've created, and it's been quite a lot, and I think that's why Rod feels comfortable with us, 95% plus of all of that has occurred through stock selection. So our men and women go out and do research. They find companies they think will go up in value or provide a good dividend or something like that, and they put it in the portfolio because they think it's the right investment to make. So 95% of the return has been at the stock selection part. Less than 5% are big tactical shifts. it's not that we don't think somebody can do it. We just know we're not the firm to do it. We think that the way we're going to win for you over long periods of time is to buy the right companies. So the way we view the portfolio as a whole is let's get the right mix of funds together at the start and make minor tweaks along the way. One example of that is we added a bit more small cap to some of the portfolios that we manage in the middle of this year. And we did it because we felt over the next 5 or 10 years, there was a reason to own more small cap in the portfolio. It wasn't because we felt the next 6 months were going to be great in small cap. It was a long-term decision based on all the data we have to incrementally add a bit more small cap and mid caps to the portfolio. We also added a bit more flexibility in the bond world, and flexibility is key for us. We like funds that have the ability to pivot, like a fund like New Perspective. It could be in the US or non-US, so we don't have to make a big decision from the top. We're letting all these ideas bubble up, and if the fund ends a little bit more US based, that's because we're finding more value there. It finds itself a little bit more international, it's because we're finding more value there. But ultimately, the little tweaks that are happening at the portfolio level that you're seeing in the combination of all of these are happening organically and not because somebody had this big idea that we need to get in or out of one asset class. So we make minor tweaks. We're always monitoring it. So that group of individuals I showed you earlier, they get together basically on a weekly basis to make sure that nothing major has changed. On a quarterly basis, they do some general rebalancing. And then maybe once or twice a year, they're going to look at some long-term data and say, okay, do we have to make some tweaks that will help the portfolios hit the objective that we're looking to for the investor over the next 5 or 10 years? Last thing I'm going to talk about in this system or this part, all of our investment professionals that work in this manage money in underlying funds. And the way they're compensated is harmonious with the way we're asking you to think about it being investor. And this is what I mean. If you looked at the industry as a whole, investment professionals are paid on their 1-year return. So it's always, what have you done for me lately? And there are a handful of firms, we're amongst them, that have asked our investment people to think more long-term. We pay our investment folks on their 1, 3, 5, and 8-year rolling returns. And 75% of that compensation is on the 5 and 8 year. Why does that matter? I just told you we're long-term strategic investors. We're trying to get it right over the next 5 and 8 years, more than we care about getting it right over the next 5 or 8 minutes. And I really think that's key, because if you're thinking near term, you might make a decision that seems to make a lot of sense, but it only makes sense in this little narrow bucket where if you're thinking about things over 5 and 8 year periods, we're more likely to get it right, especially knowing in the near term, it's really hard to get a trend right. In the long run, it's much easier to see what might come down the road over the next 10 years versus what might happen just in the next 10 minutes. So I'm going to make a real quick pivot, and then we'll open it up to Q&A about our views halfway through 2021. And I'm gonna make these comments based on 3 talking points. I'm going to talk U.S., international, and fixed income or interest rates real quickly. It's been a good year, 2020. If you had told me all that was going to happen in 2020 and then told me the market was going to be up, I would have laughed at you. I would have said you were crazy. But we had a really good year, and it's continued. Our base case, so if you put all of the thought process together, we think there's continued growth for the following reason. There's been coordination globally to keep interest rates low. So it's not just the Fed. Globally, central banks have kept interest rates really low. They've made money more available. And at the same time, there's been growth in the economy. Generally, when you see central banks like lowering interest rates, it's during a period of economic downturn. And we had that, don't get me wrong, with COVID. But as we're coming out of it, the central banks globally have stayed to this, let's keep interest rates attractive for investors or attractive for loans, which will keep the economy moving. And you have those two things happening at the same time. Generally, you've seen stock market appreciation. And we think that that doesn't change in the second half of the year. So the big picture would be, we think it's more of the same. It doesn't mean there won't be some volatility, but given those two inputs, we do think the market stays good. But we want to make sure as investors that you're staying balanced. We're doing that in the portfolios we run, but we want to make certain that you're not over-owning one area over another. And here's the reason. There's 7 stocks that I talk a lot about. I call them Mount Fang. Mount Fang stands for Microsoft, Tesla, Facebook, Apple, Amazon, Netflix, and Google. Those 7 stocks. They're more than 25% of the S&P 500. So if you just looked at the US benchmark, that's most commonly known, it's the S&P 500. More than 25% of those, it's actually 505 stocks, would be represented by the handful I just mentioned. And they did really well in a COVID world. Since November 6th, there's been a shift back towards more traditional dividend payers. Because we've been more balanced, our portfolios have done really well in light of that. And the reason we think that's the case, if you think about COVID and think about someone pushing down a spring, if you stay in your house long enough, you have a whole bunch of momentum, like a spring being pushed down. When they finally tell you it's time to go out, everybody and their friend are going out. I mean, I was in Irvine the other day and I went to Houston's. I got there at 12 o'clock and luckily I had made a reservation. There was an hour and 20-minute wait to get a table at Houston's in Irvine on a Wednesday afternoon at noon. People are ready to go. And what we've seen is there's been a shift in some of the return profile away from the stay-at-home or tech stocks that did so well, more to the travel, entertainment, leisure names. That shift started around November 6th. If you look deeper, the reason November 6th is really important is that was the day that Moderna got approval, emergency use approval in the United States of America. So at about that point, you started to see a massive shift in return profile as the world gets back to more normal. And it's reminiscent to our investment folks of what happened after the Spanish flu of 1918, 1919. If you remember what came next from your history books, it was the Roaring 20s. And it was people just wanted to get back out. They wanted to enjoy experience. They wanted to travel. They wanted entertainment. And we think that as we go forward, you're going to see a lot of that in the U.S. and international markets. So from a U.S. perspective, we think there's a bit of a shift. And that some of the, go back to real life stocks make sense. You'll see that in our portfolios and a little tweaks. We've had a little bit more of the dividend payers across the portfolios. Secondarily, I get asked all the time about inflation. And the reason I'm asked about inflation is our government, both sides of the aisle, I don't want to talk politics, but both sides have spent a lot of money. And the way they've spent the money is they printed more treasuries. And I can make a case for you for both inflation and not having inflation. What I struggle to build a case for is printing $6 trillion more dollars and not seeing the dollar's value go down. So why does that matter? We have been in a 10-year bull market for the dollar. And when the dollar does well, generally, US stocks do better. From 2011 to 2020, we had a bull market in the dollar. The US stock market beat international markets by 8.96% a year. So over 100% cumulative extra returning on the US. So what does it cause people to do? They've forgotten about international stocks. We think they're cheaper. I'm not telling you, like, this is not the point of the presentation where you go, Rod, Damian said sell all my US and buy international. No. But in a really well-balanced portfolio, we think you should own some international. You'll see that in the models. And I know you'll certainly see that in the in the individual funds that Rod buys here at American Funds as well. Last thing that I'll talk about, then I will be quiet, I promise, is rates. They're really low. I'm not going to suggest to you that they can't go up a little bit, but a lot of what's happened in the last couple of years, a lot of the rebound has been because money has been cheap. The house that's right behind me sold at a price a lot higher than it should have because somebody can buy it at 2.5% 30-year fixed rate mortgage today. So you know, the beauty, and we've all bought a car. When you go to buy a car in the US, they don't ask you what you want to spend. They go, hey, what payment can you afford? And then they figure out what car you can get and how long you have to finance it. You know, when I started, the first time I bought a car, a normal was like 4 years. Now, like you can go in and they'll give you 7 or 8 year loans to get a car. It's all about managing that payment. Same thing in housing. People want to know what they can afford based on the payment. And when rates go low, it makes things look more affordable. That's part of what we're seeing today. And we think you're in a world where it's almost like a self-fulfilling prophecy and a loop where the Fed and central banks globally will be forced to keep rates lower for longer. We do think at some point you start to see them move up a little bit, but you know, if you remember back to 2007 when you could get a 5% CD, Rod, have you seen any 5% CDs floating around these days?
No, man, I haven't seen it.
You know, today 5% is a high yield bond, and that's really different than a CD.
Right.
And you know, if you're waiting for that day, I think you know, I jokingly said the other day, I'm not sure I'll see that in my lifetime. So you might be waiting a really long time to find that. We just think you're going to see rates lower for a really long time because the market absolutely needs it at this point to keep facilitating what we've seen. And part of the reason we think, you know, it's a good time to be an owner of equities and stocks. It doesn't mean they can't go down. We saw that on Monday. They went down 2% in one day. Bonds, a bad year in bonds is like Monday in stocks, right? So that's why we still want to own bonds in a portfolio as a diversifier. And we certainly do in our models. But, you know, when you think about broader portfolio construction, equities are an essential part to make sure you hit your objective for most investors because, you know, rates are just going to stay low and that doesn't provide much of a return profile. So, Rod, I don't know. It looks like there's some Q&A available, but I'll be quiet now. Like I said at the beginning, I appreciate you allowing me to be here and pontificate upon your wonderful investors.
So, Damian, just to be clear, your analyst outlook for the balance of the year, the second half of the year is
positive.
Positive. Okay.
Yeah. Yeah. I mean, if that was one word, it's positive. And like I said, it doesn't mean there can't be volatility. Mm-hmm. And I always say volatility is an opportunity.
Yes.
But unless something major changes, right? Like people always say, what keeps your men and women up at night? Some variant that gets, you know, really jumps the vaccine.
Right.
It's not something they think is the base case, but they think about that. They think about the Fed moving too early and rates going up. Again, they don't think that's going to happen, but part of the conversation. But generally, outside of some force like that, they feel like we're in a world where you're going to continue to see good earnings with low rates and sort of you know, equities generally do pretty well in that environment.
Yes. Okay. Yeah, we look at my clients have been well schooled and they understand that when the market corrects, that creates opportunities.
Yep.
And those that own, which, you know, I would say over 95% of you have your core holdings are American Funds holdings. So that's why we have Damon speak to us at these, present at these meetings so often because American Funds makes up your core holdings. And so we do see those that have the dividend paying funds, particularly income funds, Income Fund of America, the Capital Income Builder, those are very solid dividend performers. And all of you have dividend reinvestment with those funds. And so when the markets are down, we're getting more shares at a discounted price. So when markets dip, that's actually a good thing, okay, over the long run. So we do have a couple questions. The first question comes from very dear client, David Bybee. Let's see, while I fix my glasses, Jake, maybe you want to take that.
Yeah, I can take it. No worries, Rod. Yeah, so David asked, what sectors do you think will thrive as the economy continues to recover?
That's a great question. And the way I'd frame it is, I think of COVID, and one of our managers said this is a tidal wave. And there were three outcomes from the tidal wave, right? Outcome one was you couldn't swim in it and you just sunk and you went out of business. Well, the outcome for those companies and those industries already occurred. Then there were some companies that swam through a tidal wave, and I don't know if it was swimming or just bobbing their head above water and just staying afloat. And we'll get to those in a second. And then there were companies that got on a surfboard and rode the wave. And if I think of those companies that did the best during COVID, I'm thinking healthcare and technology, right? Healthcare, obviously, because everybody was worried about their health and doing things to promote that, and obviously vaccines with Pfizer and companies like that. And then technology, because we were all stuck at home. So if you couldn't go to the mall, you went on Amazon. You spent more time on Netflix and Disney Plus and all that. So that made a lot of sense. Now, if I pivoted back and said, there were these companies that made it to the other side of COVID, and there's a lot of pent up demand. I don't want to suggest that any of these make sense today, because some of this return profile already happened. But what we would tell you is travel, entertainment, things like that are areas that generally would have been investable to us before COVID, got beaten down because of COVID, and will normalize. Now, some of the return has happened already, but you think of airlines and hotel chains and restaurant companies. Now, the big uptick to many of those happened after November 6th, when you got a vaccine and you started to think about recovery. So some of the easy money has been made, but that was an area, those were areas that we thought you could take advantage of, because for a moment it felt like that was never going to happen again. And now, I don't know if you've been on vacation lately, but airplanes are full. You go to hotels, they're full. I was in Park City and we went mountain biking, and it felt like more like bumper cars than mountain biking, because there were so many people on the mountain biking down. So some of that has normalized, but those are areas, and there's always stocks that make sense, but right now we're finding some opportunities in those dividend heavy companies that we think made it to the other side and will benefit from people getting back to living their life as they once did.
Yeah, very good. Jake, I'm going to let you field all the questions.
Yeah, no problem at all. Okay, so we had another one come through. How can you make the distinctions between more short-term positions versus long-term? Are there any clear signs or factors?
Yeah, so that's different in every firm. And I don't know who asked the question other than Jake asking it to me, so I won't address the name. But
well, it's my nephew.
Oh, well, Rod's nephew. Yeah, so from our perspective, we tend to take a much longer term perspective, and there are companies out there, and we're not generally one of them, that will try and invest in short term trends. With that said, there were some trades that we take long term perspective, but there were trades that were made. We were buyers in the beginning of this year of some of the banks, European banks, U.S. banks, some of the energy companies that we weren't sure the fundamentals changed for them in any great way through COVID, but they just got so stinking cheap. We thought we could make some quick money, and I think that's really where you differentiate it. What is a long-term trend that you see that's going to revolutionize something like autonomous driving? It's not going to be here today. I mean, some people will argue Teslas do it, but there's a great feeling that 10 years from now, it will be standard issue, and that's the way cars will go. So what can we invest in today that over the next 10 years, and it doesn't just have to be Tesla, like that's the first derivative, but what tech companies provide infrastructure to that working, and that would be the long-term investment ideas. And a short-term investment idea is like I just mentioned. Banks got too cheap, and they sort of acted like they were not going to exist. We didn't change our view that they still have some headwinds for long-term success. So maybe we don't want to own them for 10 years, but for 10 weeks, they went up like 50%. So owning a little bit more than you did at the beginning of the year made sense. So that's sort of the way we look at that near-term opportunity versus, which is something we do in much smaller increments, and the long-term viability of an idea that we think disrupts the world, much like, I would say my iPhone, but I've got two of them, right? I've got two of these, one personal. And when they came out with the iPhone, it disrupted not only the way we think about phones, but who would ever own an encyclopedia when I've got Google at my fingertips and I can talk to Siri and tell her? So there was so much mass disruption from that one investment that Apple, we thought, was a great investment. And we were the largest holder of that as an organization for 5 years.
Sounds good. We had 3 really good questions come through from Joseph Wyatt. The first one, Damian, can you provide some context on how the target return across the 5 model portfolios vary outside of the RJ score system? So, at Raymond James, the American fund models, they range from conservative to growth. So the question is, Damian, what is the target return for kind of each of those models?
So we don't look at it as a target return per se, because just the reality of the underlying marketplace changes, right? So a 10-year return might look really good in a bull market and less, but I can give you, I'm just trying to pull them up here, the 10-year return of each of the models to give you perspective of what the last 10 years look like. So I'm going to start with the most aggressive. So the growth portfolio the last 10 years, and this is as of the end of last year to give you perspective. The growth model was up, its average annual return was 13.97%. It might not look like that the next 10. It might look better, it might look worse. I don't know what the next 10 years will bring, but it will give you a perspective in relation to one another. If you looked at the, so that's RJ growth. If you looked at the balance with growth, which is our growth and income portfolio, so it's got more bonds, and it goes from 13.97 to, this doesn't work that well. Let me go down one more, 10.24. So less volatility, a lot less volatility day to day. But if you held it over the course of the 10 years, you had about 3% more return in the growth of your portfolio. The RJ balanced, which is the moderate growth in income, was went from 10.24 to, I'm not going to try and look at you guys, I'm going to 9.11. So you gave up about 1.3% per year average annual return to get even more conservative, less volatility, less drawdown, and remember, more income associated with this portfolio. When you look at the conservative growth in income, so about half the portfolio is more focused on bonds. That return went down to 7.03% over the last 10 years. And again, if you had told me 10 years ago that a conservative 50-50 portfolio was going to drive 7% per year, I would have been really happy. So it did really well for a 50-50 split, but obviously an all equity portfolio at 13.97 was a bit more. And then finally, the conservative, but that was the conservative. So I hit them all at this point. So I got, yeah, that was all 5.
Sounds
So-
good. And then, yeah, another question from Joseph Damian. How does ESG factor into the capital group process?
So that's a wonderful question, and ESG has become more important, and some of it is simply ESG has worked, and the reason ESG has worked so well is generally if you get rid of energy in the last 10 years, which has been the worst performing asset class, the return profile is better. But the way there's really three ways you can think about ESG. Way one is you do nothing and you don't care about it at all. So that's a possibility. The second way, and the most intense, is think about it from an exclusion perspective, right? So we're just not going to own certain industries because they don't hit our mark. Now, that's really hard because if you're a Catholic values fund, your view might be very different from somebody whose only focus on ESG is climate change. So it was really hard to judge. The way we have viewed it as an investment manager is not exclusion and not to not think about it, but what we would call engagement. So our process, all of our funds, all of our holdings go through a screening system. And if you're interested, I can get the information to Rod and he can get it to you. And we will tell you each of our funds how many of those individual stocks have been flagged by one of the ESG rating companies. Now, what's interesting is you virtually see none of them that have hit all of them. So it's a, what's ESG to one is not necessarily ESG to all, but we think we can have a greater impact by engagement of management. For example, we worked with a firm and they were getting a check mark because they weren't, their boardroom wasn't diverse enough. And the conversation we had with them is that not only would they score better from an ESG perspective, but we thought they would have a better outcome from having a more diverse view of the world in their boardroom. And they heeded our advice and they've actually changed. They're no longer getting marked as not compliant with ESG because they have a more diverse board. So we feel, and again, there are companies that will do the exclusion. We feel engagement is the best way to help make the world better for everybody. So that's the area we've focused. And then the last thing I'll say on that is we do offer some separately managed accounts, which you have access to, that allows us, if somebody wanted to take a more exclusion basis where they could exclude certain industries or certain stocks, if that was important to them. But that's the way we view it, ESG. And again, I can get you more information if it's something of interest. That I certainly can get it to Rod and get it to you if you want more information about the way we view it and some of the holdings that we have.
All right, and just for the clients that don't know what ESG stands for, it's environmental, social, and governance. So we just want to make sure that we kind of explain that.
Rod, I'm glad you did that because we get so used to it, and then when the question came in asking about ESG, you just assume, well, he's asking about ESG. Everyone knows what it is, but you're absolutely right. It's 5 years ago, no one knew what that term is, and certainly everyone in our industry does today. But we have
more and more clients that are, they're more socially conscious about what's going on in the environment and those types of things.
And Rod, if I can add one more comment, Rob Lovelace, who's the principal investment officer of one of our best funds, New Perspective, his grandfather founded the firm, and quite honestly, one of those guys that when you sit and talk to him, you go, they sort of see, everybody sees derivative one, he sees down the road 2, 3, 4. He said to me in a conversation, 10 years from now, I don't think there will be ESG investing. I just think it's going to be investing. And the reason he said that is he said it's so important to so many that companies like ours that are taking a thoughtful approach to helping organizations figure it out. He feels that like the boardroom everywhere is just going to think about the world that way, and you're just going to be in a world where that's not an issue. And I hope he's right. It's a better world if that's the case.
Right. Great questions, Joseph. And I think Joseph has one other question.
Yeah, one more question, Damian, from Joseph is, you mentioned concerns about a new variant or the Fed moving too soon. Where do your analysts see risk to the upside?
That's interesting question. I mean, the big risk to the upside would be, so our base case is this, that the world starts to normalize, more and more people get vaccinated. Certainly, you know, in the United States, we're getting there, not as fast as some would like, but certainly getting there. The rest of the world, if you rounded it out, is probably close to zero. So we're blessed to live in this country for a lot of reasons. I think sometimes we all take it for granted, but you know, if you wanted a vaccine, you got a vaccine here in the States, and the rest of the world will catch up over the next few months. So the thing that could create more upside for us than anticipated is that rollout going quicker and COVID just going away faster. Because you know, if you put 9 people in a room, 3 people think COVID was a hoax to begin with, 3 people are still scared and not leaving their house, and 3 people don't know what to think. And that's sort of the way I view it. In order for to surprise on the upside, you got to get the 3 people that are still at home nervous to feel comfortable going out. And I think the best way to get that is more people vaccinated, my humble opinion. But as that occurs, that could be the upside surprise that it doesn't take into, you know, into 2022. We get to the end of 2021 and COVID sort of in the rearview mirror, and no one's thinking about it. It's not on the news, and stocks could really jump off of that.
Awesome. Very good, Damian. Excellent answers. Great questions, guys. Let's see. Are there any other questions? All right. Well, this has been great as usual, Damian. Yeah, we appreciate you, and you always do such a great job for us. And we look forward to having you back to kick us off for the new year, 2022. Hopefully you'll have a great report for us. Hopefully we'll finish the year very strong from a performance standpoint. And we look forward to getting together in person next year, hopefully with you and our clients.
I wouldn't. Nothing would make me happier than to give you a hug, Rod.
Yeah, that sounds.
Even
great,
if I end up somewhere in your belly because you're just way too tall for me.
Yeah, that's true. That's true.
At least you're honest about it, right? Like,
right.
And I think did one more come in?
Do we have one more, Jake?
I thought one says, "Can I ask one more?" But I don't see a question on it.
Yeah, her question hasn't come through, but yeah, feel free. Go ahead and submit another question. Absolutely.
Okay, so I think we have one more.
I wish it was a little colder and you had a fire going over your shoulder, Rod. That would make this like.
I know, huh?
If we're forced to do this in the fourth quarter, I want a Christmas tree behind you and a nice roaring fire.
That's what we'll do. I don't think we have another question.
Oh, it must have went away.
Yeah, I think it went away. Well, listen, guys, this has been great. As I said, over 95% of you have American funds in your portfolio as a core holding. And so, the performance has been excellent. And we appreciate you tuning in. We look forward to having you back next month. We have another great lineup for you. We have, I believe, Brown Advisory Group. And is that correct, Jake?
That's correct. And I would just say Brown Advisory is one of the founders of ESG Investing. For those of you that are interested in ESG, that would be a fantastic webinar to tune into. And Raymond James's investment committee here in asset management, we have plenty of white papers on ESG investing. So if you do want to learn more about that, shoot Rod an email and I'll make sure I send those over to you.
Wonderful. Thanks so much, Jake. You do such a great job of moderating things for us. We appreciate you so much. It's great to have you on our team here at Raymond James. All right, guys. So with that, we bid you adieu. Have a great weekend. Get out there and get some vitamin D, and we'll see you next time on Money Talks.